Hi, I'm Mike Reddy from NZTax.com.au. Thanks so much for joining me. I often suggest to my clients that paying New Zealand provisional tax is something of a gamble, and here's why I say that. First of all, a quick introduction of the New Zealand provisional tax system. Now, provisional tax is paid during the year based on the tax that you had to pay in the previous year, and then they add another 5%. What I'm meaning by that is if in the previous financial year your tax bill was, say, $30,000, then the provisional tax you'll need to pay during the current tax year is 5% more than that $30,000 or $31,500. The provisional tax dates of 28th of August, 15th of January and the following 7th of May. Now that's depending on a standard New Zealand balance date of 31 March. Now you may want to move that 31 March to 30th of June, and if you'd like to do that, just contact us. We can help you with that application. But assuming everything is standard, then the provisional tax payments you would have made each period were $10,500. Let's just say that the current financial year has now ended. You've completed the tax return and you find that this year wasn't quite as good as the previous year. In fact, in this situation, the tax that you have to pay instead of the estimate of $31,500 is just $24,000. And look, that could be $240,000. It doesn't matter. This is purely for illustrative purposes. So we've completed the tax return and your actual tax payable is $24,000. Then the provisional tax calculation takes that $24,000 back and it says, well, had you have known exactly what your tax was that you had to pay for the year, you would have, instead of paying $10,500, you would have just paid a third of that, which is $8,000. So you would have overpaid your August payment by $2,500, you've overpaid your January payment by $2,500, and you've overpaid your following May payment by $2,500. So not only have you got this overpaid tax tied up with inland revenue to the extent in this case of $7,500, but you're going to have to wait for that money to be refunded. Now, after you file your tax return, inland revenue may choose to return that money immediately, but under the law, they can hold on to it for another 12 weeks. That's 3 months for any reason, just to look at things. So you're going to have to wait for that money to come back. To compensate you, inland revenue will pay you interest on that money, but not much. In fact, at the moment, that interest rate is just a smidgen above 2% per annum. That's all you'll get. So consider that it's probably costing you more than 2% per annum to borrow those funds, to pay inland revenue. You're already in a loss situation. Let's just say you had a cracker of a year this year, significantly better than the previous year. Your tax return has been completed, and instead of the estimate of $31,500, you find that you have to pay $42,000 in tax. So in this case, you've underpaid your provisional tax. And with 2020 hindsight, you would have known that if you had to pay $42,000 in tax, each of those provisional tax payments would have been a third of that, 14, 14, and 14. So in this case, instead of the 14,000 you paid by their rules using the safe harbour method, 10,500, that's resulted in an underpayment of $3,500 for each of those 3 provisional tax payments periods. So because of that, inland revenue will then not only expect you to pay that shortfall in tax, but they will also charge you use of money interest. Even though you've followed their rules and what you paid each provisional tax payment, they're going to charge you interest on that, but not at the rate of 2%. No. In this case, they will charge you at over 9% per annum on the underpaid tax, even though you paid tax based on their rules using the safe harbour method. So if you've underpaid your tax or overpaid your tax, you've lost out. And that's why I refer to paying New Zealand provisional tax as a gamble. How we can help you significantly reduce the cost of that gamble? Join me in this next video.